Morning, good afternoon, everybody, depending on where you're joining from. So thank you for joining today's session, the WiBA session, which is what strategies to adopt to mitigate risk in renewables energy in a project in Africa. And that's the WiBA. And just to reiterate what WiBA concept is, it's simply a forum for us to discuss the opportunities and the challenges that the continent of Africa faces in two sectors, so renewables energy, but also technology. And today we have two fantastic speakers, and I'm sure you can't wait to hear more from them. Okay, so now if I'm just gonna go, I'm just gonna give you very quickly, remind you what the role of the house is so that we can all have a very interesting conversation this afternoon. I've turned off your camera for all of you. So I will ask you to stay with your camera turned off, except the speakers, and same thing for your microphone. So you obviously have the right to ask us questions on the chat, and we're going to be addressing that during the Q&A session at the end. Feel free to send us your feedback, and last but not the least, we want to make sure that you enjoy yourself. Today we have a great session. Why? Because we have a lot of people that registered. I know not everybody turned up. And by the way, I know there was a confusion with the time. We apologize for that. So it was 1 p.m. GMT, which is 2 p.m. London time. But let's put down behind us now. So we're here and we're focusing on the conversation. We have people that are joining us from financial services, from banking, from consulting, and obviously energy. And I'm sure the conversation is going to be covering all of these aspects, and then we will have the Q&A session to address questions that are very specific to the speakers. So what is the agenda? As you can see, a very brief introduction of what renewables in Africa is, talk about the topic of today's, leave the speakers do their magic, and then we're going to respond to your question at the end, and it's going to come the time for us to conclude. It's going to be very quick, I can promise you. So, what is renewables in Africa and what drives us? Very simply, so we're looking at turning Africa from the image that you can see on your left. That's what I saw in 2008 that at the time shocked me and made me angry. Turn that into the picture that you see on your right, which is an African continent that is bright and that is happy, proud, and hopeful. So that's what we're looking for, people like me who work with me. And our mission is very simple. We want to bring back power into the continent of Africa. So what is renewables in Africa then? So we are proudly a two-in-one company. That is a clean energy engineering consultancy, working with developers, investors, and project owners. And what do? We do project origination services to help these clients to identify the right project. We heard so many times, it's so difficult to find the right project in Africa. But we also provide the market insight and the business intelligence to allow you not only to enter the market, but also to grow, right? And last but not the least, technical and strategic advice. These are to allow you as well to improve the attractivity of your project. But most of you will know us because we are a media platform. So we see ourselves as an African clean energy champion. And our mission is very simple. It's to promote and raise awareness about the sector across Africa for businesses, but also the general public. And you can see on the right-hand side an image of how our interface currently look like. So I would invite you to look at that if you have not done that. So some of our publications, so you will recognize that. We've talked about the wind industry outlook, so that was 2 years ago. We had a collaboration with GuarantCo that's talking about the discount rate. And early this year, we released our first solar tracker, and we're going to have the next one that's next year that we want to publish year on year. So that's what we see. And what is coming up? We're going to be launching very soon our workshop that will be happening on the 27th of November, where we will be looking at renewables in Africa, no pun intended, looking at the inside, but also how to source bankable projects, because issues that we're hearing all the time, there isn't any issue regarding the fund. It's all about how do you identify the bankable project. So that's what we're going to be looking at. If you're interested, make sure that you register for the webinar. Today's conversation, we will be talking about strategies to adapt to the risk in renewable energy project in Africa. Why? We know that renewable energy is perceived as risky. It's even more riskier when people are thinking about emerging markets and also Africa. But we also know that solutions, there is no one size fits all solution. There are a variety of solutions. So what can we do to mitigate those risks? That's why we wanted to bring forward for you two very renowned speakers. So we have Hoda Moustafa, who is the Africa regional head for MIGA. All of you heard about MIGA. So do you know what MIGA does? If not, that's what you're going to find out today. And also I'm having Jules Samain that works for GuarantCo, who is the regional director for West Africa and also North Africa. So the conversation that we're going to cover, you can see some of the questions that we're going to be addressing. And I want to make sure that I leave time for our speaker to introduce themselves and then go on with the presentation. So that's the time where I'm asking Jules, who's going to be starting. Jules, are you online? If yes, can you share your presentation and take it from there, please?
Yes, I'm online.
Okay, I'm going to be stop sharing.
Yeah.
And I'm expecting you just to share your screen, if you don't mind, please.
Okay, just give me 1 second.
Absolutely.
Can you see my screen?
I can see your screen. Brilliant.
Okay. Thank you, Tony. Thank you for inviting me to do this presentation for this webinar. It's quite an interesting subject, I have to say. Given the interest people are having for Africa, it might be good for investors and also everybody interested by Africa to know exactly what sort of risk they are running by trying to do a project in Africa and what kind of mitigation are in place they can find to mitigate those risks. Before we start the presentation, I'm not sure everybody knows about GuarantCo. If you can give me 1 minute to quite do a quick presentation on GuarantCo, that would be great. GuarantCo is the guarantee institution set up by a few G20 government, which are the UK, Switzerland, the Dutch, Australia. And GuarantCo has been set up to provide risk mitigation product. The idea of that is to help make sure that investors are kind of safe when they get into a project and that they share the risk with an institution like GuarantCo. And the most important thing to say is that GuarantCo is looking at local currency guarantee, which means that we are trying to attract most of the pension fund, local pension fund, insurance company to provide funding for the project, while GuarantCo is providing mitigation instrument for them. Also, we can look at international commercial bank. This is to say that we are more of trying to crowd in private sector investors to put money in those infrastructure with the aim to develop all the low-income countries around the globe. We operate mainly from London. There we have few offices around. We have one office in Nairobi, one office in Singapore, and we will soon be opening another office in West Africa, which is going to be based in Cote d'Ivoire. Through this presentation, I'll probably at some point talk about the kind of product that we offer. And to go through my presentation now, one of the questions that I have to ask is, what are the main risks I encounter in renewable energy projects in Africa? We kind of trying to highlight a few of them. And where we say the main risks that we can see are performance risks, project performance risks, payment risk, contract risk, currency convertibility and transferability risk. And there are other sort of risks which are also important, which is more have to do with the project finance type of structure or even corporate finance, if that is the case. As far as performance risk is concerned, I think For us, the performance risk is mainly based on the operation, looking at how the company operates, all the risks that can come from there. And also, we look from the construction, we look at the type of equipment that the company is looking to put to build the plant. We look at things like acquisition, land acquisition, if there's any issue that can prevent the company running the company, we consider that performance as well. There's also grid and transmission line, because there's a lot of, in Africa, there's a lot of issue on those points, like grid transmission. It's not just building the plant. We need to make sure that even if we build the plant, we can distribute, we can evacuate the electricity coming from the plant. As far as payment risk is concerned, we look at the off-taker payment risk. As you know, most of the utility company in Africa, they don't have a strong capacity, not just because they don't have ability to pay, but just because their sector have some issue where the government sometimes subsidize the pricing, and the government more often will not pay that subsidies to the utility company. The next risk is the contract risk. This is the risk that occurs when the project is unable to perform according to a key contract because of certain action by the host government or off-taker, things like expropriation, civil war. The next risk is the concurrency and convertibility risk. This is when the government imposes capital and exchange control by sovereign entity. This will prevent or materially impair the ability to convert local currency into foreign currency. We will see at some point in my presentation what kind of mitigation government in Africa are putting in place to make sure that this don't happen. And other risks that we can see are things like breach of contract, expropriation, war, civil disturbance, and yeah. So, and the next question we have been asked to answer was how to mitigate this risk, which is very important. We have three points: enabling environment, commercial viability, and robust PPA. As far as enabling environment is concerned, we need to have strong, independent institutions which can be seen as acting impartially. Basically, we need to have strong off-taker, strong utility company. Sometimes, depending on how the electric sector is structured, we also need to have a strong distribution, transmission company. Transparent, fair and legal process, fairly legal and regulatory process. We need to look at the tender, how the tender was managed, how the bidder was selected, how the IPP, the project sponsor was selected. Look at the procurement process. The next mitigation has to do with the commercial viability. We need to make sure that the project commercially is viable. The project doesn't depend not just on the subsidies, that the costs paid by the off-taker to the IPP can make the project sustainable. Robust PPAs. When I say robust PPAs, is we need to have a really strong bankable PPA. Things like government provision or guarantee or support to project structure need to be there. We need to look at those. We need to make sure the cost, as I've said, reflective, the cost and the tariff are bankable. Is not. We need to avoid as much as possible to have subsidies when it comes to PPA, because if the government is not strong enough, you might end up in the position where you have subsidies that are not being paid to the off-taker. Therefore, the off-taker cannot pay the lenders and cannot pay the sponsor. So after showing how to mitigate the risk, one point that I need to mention is the GuarantCo mandate, because some of the products that we offer also have to mitigate those risks. So something that I didn't say in the beginning is that GuarantCo our guarantee range from $5 million to $50 million in local currency, and the maximum tenure we can provide according to our policy is 15 years. And we offer a few range of products, such as partial credit guarantee, where we take out the credit risk from the lenders and provide a kind of pari passu credit enhancement facility to them. We also have, because of our flexibility, we can structure our guarantee in many ways, such as the first loss guarantees, where we take the first loss if there's any event of default. And as we are developing the market, developing GuarantCo activity, we come to realize that some of the commercial banks, for them to be part of renewable energy project, they need to have a long-term liquidity, which is not the case in the market where they operate. That is why we decided to put the tenor extension facility in place, which is kind of the same thing as the liquidity guarantee. The idea of those products is to extend the tenor of the lender's facility to the project and to help them to provide, let's say, 15 years financing rather than 7 years, which will not really help the company, because when you look at renewable energy, the only best way for the project to be bankable, one of the ways is to make sure that they can have access to long-term liquidity. Because the commercial bank cannot provide those long-term liquidity, GuarantCo is helping by providing the tenor extension guarantee or liquidity guarantee. Those two products, the difference is where the kind of structure that we put in place, depending on which jurisdiction we want to provide those products. We also have joint guarantees, where we can provide a guarantee with other institutions operating in the area. And if there's any need to accelerate the construction, GuarantCo can provide an EPC contractor guarantee, which is a kind of bridge loan. The idea of the EPC contractor guarantee is to help the EPC contractor to start the construction while the project is working with the senior lenders to make sure that the senior lenders are quite satisfied and they're happy to put money into the project. Those are the products that we provide. How our guarantee works, depending on the product that we are providing, mainly we provide a first demand guarantee when it comes to partial credit guarantee. First demand guarantee means that if there's any issue and the project cannot pay the lenders, GuarantCo will step in up and pay according to the percentage of the guarantee that we provided in the beginning. We also do that if there's any bond, if the project is issuing a bond, a project bond, we can provide a guarantee which will work the same way. But the beneficiary of that guarantee when it comes to bond will be the bondholder. Yeah. In terms of process, our process, when you look at what it shows, what we are seeing on your screen now, the process looks like it's a long way to go, but it's not really a long way to go, because the way we operate as a private company, private sector company, we're trying to shorten the process as much as we can, making sure that we are doing things properly. The first stage is to where we originate the transaction, bringing the transaction on the GuarantCo platform, and we will do some preliminary check on the KYC to make sure that there's no reputational risk for us being part of this transaction. If that is okay, we will prepare what we call a new business community to get their approval in principle. And after that, we'll prepare the mandate letter, which is going to be negotiated and signed between GuarantCo and the project sponsor or the bank. And then we'll start the due diligence. Our due diligence process is the same as any other development financial institution out there, where we're trying to identify all the risks and provide mitigation as much as possible for the board to be comfortable. And this paper will be presented to the board which is the credit committee for the approval. If that is approved, we will work on the documentation, legal documentation, such as the report agreement and the guarantee itself. And we will also give time to the project to complete the CPs. And when those CPs are completed, we will get to financial close. So if you look at this process, you will understand that this is the same process as lenders, because we consider ourselves as lenders, even though we are providing a guarantee, because the guarantee that we provide is a first demand guarantee. There's no condition on our guarantee. There's no waiting period. Also, one important thing to know is that GuarantCo is AA- rated by Fitch, A1 by Moody's, and in local currency fund, local currency we have AAA. Nigeria, West Africa, and Kenya, we have AAA rating, which shows exactly how strong GuarantCo is. And an important point to mention is that when we started looking at West Africa, we realized that it might be good for us to get our guarantee being recognized by the central bank, which we did for CEMAC zone and UMO. And in other jurisdictions, depending on the central bank, we most of the time get the approval before we issue a guarantee to make sure that the guarantee that we issue to the bank makes sense for them, and also we help them to mitigate some of their regulatory risk, regulatory ratio. Sorry. That being said, another question was to think about what are the cost implications of purchasing insurance or guarantee. In this case, we're going to talk about the guarantee. It's a bit difficult for me to say that the costs have a negative effect. And that's why when you look at my presentation, the first line of my presentation said, from a full project lifecycle perspective, guarantee can be considered as cost positive. Because the guarantee, one of the main things that the guarantee has to do is to de-risk the project. And the guarantee also helps to provide a comfort to lenders to be part of the transaction. So it reduces the financing risk, increase the tenor, and help to raise funding in the market where project finance is not something that the market knows. And having a guarantee will give a lot of comfort to lenders and pension fund or insurance company when it comes to bonds. The last question is Africa becoming more or less risky? There are many ways to answer this question, but I'm going to answer based on my experience. I think Africa becomes less risky. Less risky because there's a lot of policy enhancement in most of the countries. I think those governments understand that if they want to develop their country, they need to enhance their policy and make sure that those policies are attractive to investors. There's a lot of political stability as well. There are a few countries where we still have some issues, political issues. But I have to say that today, I might be wrong, but my view is that like 65%, 75% of African countries, they are kind of more stable politically. And we also see that there's a lot of improvement on the governance. On the electricity sector, there's a lot of reforms on the electricity sector. I think the World Bank is also helping those countries on those reforms. I just came from Mali, where I had extensive discussion with most of the people operating in the electricity sector. And you can see on World Bank website, a report that was issued by a consultant to help the World Bank to restructure and provide some financing for the sector. It's quite clear that most of the head of states they're taking that direction because they believe that electricity is the most important element for their development. And if you also look at some of the utility company in Africa, if you look back, let's say in 2000, they were not strong as they are today. Some of them are now bankable. I just want to take the case of Senelec. Senelec, 5-6 years ago, it was difficult for any investors to go into Senegal for energy project because Senelec was not that strong. But I think now the company is getting more and more strong. They understand, they have done a lot of restructuring. They have tried to make sure that they are operating according to the standard. There's a lot of things to do, but I think they have sent a positive message in the market. And we can have a lot of examples like that, which at the end of the day tell me that Africa is becoming less risky, and head of state, governments, they all understand that if they want to develop the country, they need to enhance policy, make sure that their country is politically stable, and improve good governance. I think that's all for my presentation. If there's any question, I'm happy to take them.
Thank you very much, Jules. That was a brilliant presentation, and what I can see, and as a summary, is that yes, there's a number of challenges that need to be addressed, and you guys are offering some solution. But the main point is Africa is offering for business. You refer a number of times to the World Bank and what is done at that stage to make sure as well that there are pathways for people that want to move ahead in the sector with their project. So I'm just going to invite Hoda to share her presentation and to go to that. And Hoda, if you don't mind, it would be good if we have a 15-20 minute presentation so that we have time, because there's a number of questions that people have asked, and I want to make sure that we can touch on some of them. Hoda, are you okay?
Yeah, sure, Tony. Can you hear me?
Let me turn off my.
Yes, yes, I can do that for you.
Okay.
Yeah.
So yeah, I was actually going to suggest that I actually make my presentation even shorter because I'm aware of time.
Okay.
So I can speak in 10 minutes or so, and then we can open it up for questions.
That's fine. So can you share your screen now and get going? If not, I'll do that for you.
If you could, yes,
Yes, okay, no problem. So that's fine. So can you see my screen?
Yep,
okay.
I sure can.
So,
Fantastic.
Okay.
Thanks so much, Tony. Okay, so
yeah, let me know and I'll move ahead.
No problem. So good afternoon, everyone. I'm Hoda Moustafa. I'm the Africa Regional Head for MIGA, based in Dakar, Senegal. MIGA is a global organization, multilateral organization, which works in 182 member countries. Africa is a very large part of our focus and our portfolio. And I opened the office in Africa, which was MIGA's first footprint in Africa in 2016. So next slide, please. So Jules already spoke about a number of risks, and you'll see here on the slide that MIGA's products, particularly its political risk insurance products, are intended to address some of those risks, and GuarantCo addresses others. We think that our two institutions are mutually complementary, and we appreciate being able to work with them as a fellow developmental organization to try to address those risks. But the four products that MIGA provides essentially are transfer restriction and currency inconvertibility, which covers the risk that either equity investors cannot convert or repatriate dividends, or if in the event of an exit are unable to convert or repatriate the sale price, and also that lenders are not able to convert or repatriate debt service. So we provide coverages against those risks, and there are certain countries in Africa where these are much more highlighted. To name a few examples: Ethiopia, Mozambique, Nigeria, just to name a few. We are open in all of Angola is another example. We are open in all of those markets. Expropriation is the blanket coverage, so it's more often thought of as expropriation, sort of the extreme government taking over, but our coverage is very broad. It covers any government action or inaction that has the impact of, that impacts the commercial viability of a project. So this can include changes in law and regulatory risks, what we call creeping expropriation, revocation of licenses, some major changes in fiscal regimes, anything that the government can do that would impact the ability of sponsors to gain a value out of the project or lenders to have their debt service paid. Our war and civil disturbance cover is for politically motivated violence. So this is especially relevant for what we call fragile and conflict affected states. We cover terrorism and sabotage, as well as any other politically motivated violence, not only for asset damage, which works similar to a commercial insurance, but also business interruption. So if you can't operate in a renewable energy project, if you can't operate a plant or you can't construct a plant due to a surrounding political violence, MIGA will compensate you for your investment. And finally, probably the most important for IPPs is our breach of contract. So Tony mentioned payment risk as being one of the major ones in any renewable energy project. We agree, and in fact have the most demand for this particular coverage, which covers payment obligations under either a PPA or a government support agreement, depending on the structure. Government support agreements can range from all-out government guarantees to letters of support, to implementation agreements, to concession agreements, whatever the particular type might be. And MIGA backstops that government obligation through its breach of contract cover. This typically in an IPP will cover a termination payment, and it will require that any dispute resolution process has already taken place. So we would need to have an arbitral award in place in order to pay out on the cover, although MIGA's value added comes much earlier, which I'll explain. And then just that last line there, this is just for everyone's information. It's not relevant to renewable energy, but MIGA also does have a product to provide credit enhancement for public sector projects where lenders are lending and want coverage, basically want a financial guarantee or a wrap on payment obligations of sovereigns, sub-sovereigns, and SOEs. So to give an example, we provided a loan to Eskom and DBSA in South Africa for some of their activity. Like Eskom, it was a transmission expansion. For DBSA, it was some of their lending outside of Africa. And the lenders who provided that loan had a full guarantee of 95% of principal and interest from MIGA. Next slide. So here's just some technical parameters of cover, which I won't go into. As I mentioned, we can cover either loans or equity. Also, in some cases, we can cover contracts such as EPC contracts, which we're trying to roll out actually in a solar project in Africa for the first time. We can go long tenors, and we can sort of have generally a higher risk appetite, I would say, than most of our peers in the market. Next slide. So I think I've gone over the three coverages. So Tony, we're going to skip now, if you would, the next 4 slides. Keep going. Yep, here we go. So, can you just go up one more? So one of the questions that I already saw in the webinar was pricing. And so I don't have a determinative answer as to what our pricing is, but I can provide anyone pricing, usually within a day, if I'm given parameters such as what the country is, what the tenor is, whether it's equity or debt, and what the particular risks they're interested in covering are. If you have specific questions about a specific market, please feel free to ask me, and I'm happy to turn that around. But some of the considerations that are put into play in terms of our pricing model is our pricing is based on individual countries and individual risks. We also have to test the market. We syndicate about 70% of our portfolio. So we always have to make sure that whatever pricing we provide will also clear the market, so to speak, that reinsurers will stand behind it. And in most cases they do. In some cases they'll say, actually, that's too low. We will not accept, breach of contract in X country for as low a price as you've given, and then we need to adjust it. And then of course we would need to adjust the situation. If there's security, for example, if we're covering equity and there's security over the shares, we would need to adjust the pricing accordingly to reflect the fact that our recovery is impaired. Next slide, please. This is our portfolio in Africa, about $6 billion in portfolio among 24 countries. As you can see, the vast amount of our portfolio is in Africa, 56%. And many of these projects that you'll see in the top 10 countries are in fact renewable energy projects. So just to give a few examples, we have 12 renewable energy projects in South Africa. In, let's see, Cote d'Ivoire, these are mostly gas, same with Nigeria. Cameroon, the Nachtigal hydro project. Uganda, the Bujagali hydro project. Senegal, we have a large wind project, as well as two scaling solar projects, which are PV solar, etc. So much of the interest in our products is in energy and in renewable energy in particular. Next slide. So now we can kind of go through some specific examples of projects, and I can just show some structures and then maybe open it up for questions. So next slide, Tony. Yeah, so I mentioned earlier that why people come to MIGA, especially regarding breach of contract. So the primary reason, and this is a bit odd for an insurance company to brag about how many claims they have not paid, but we do. And the reason is that the actual story is not in how many claims we've paid, but in how many claims we have managed and not had to claim due to this World Bank, what's called the World Bank Group umbrella. So if there is a problem, for example, arrears in the power sector, MIGA gets involved from the very, very first sign of an issue. If there's an invoice that's unpaid, we are immediately notified. We immediately notify our counterparties at the Ministry of Energy, Ministry of Finance, and the utility. And if those problems continue, then we would actually seek to have meetings, potentially be involved in restructuring, potentially be involved in any facilitation of disputes. And that's that protection that investors typically seek, because they know that if you have the World Bank Group umbrella behind you, then it's much less likely that you're going to have a payment issue. We are considered an honest broker because the host countries are our members, host countries are our shareholders, and the guarantee holder is our client. So our interest is in seeing these projects continue and stay on track, but also making sure that both parties are satisfied. Okay, next. So this is just, again, just to give a few examples. This was a project we recently closed in Malawi. It was a project with JCM, a Canadian investor. And interestingly, since we have Jules here from GuarantCo, one of GuarantCo's sister institutions, also in the PIDGE group, InfraCo, was also a guarantee holder for this project. 60 megawatt solar PV in Malawi. So this was the first IPP in the country that closed. It was done as all equity. And now they're in the process of bringing in debt post-CODs. It's a very interesting structure in that it was done as all equity with a deferred payment mechanism on the EPC. This is also one of the early projects where MIGA used a private sector window. We were able to tap into a concessional facility in order to essentially manage our risks and also provide more favorable pricing. Next slide. So I mentioned scaling solar Senegal. These were the two projects. We covered the investment of Meridium and NG. The other investor was the Sovereign Wealth Fund in Senegal, against the risks of breach of contract, actually all four risks. And that one you had on the senior debt side, DFIs, including IFC, Proparco, and EIB. This, as you may know, had one of the lowest tariffs in Africa, about 4-cent tariff after a competitive tender in Senegal. Next. Nachtigal in Cameroon, of course, you're all familiar with, very large transformational hydro project. This was one that benefited from a PRG from the World Bank, partial risk guarantee, to cover liquidity, as well as a guarantee of local currency. So again, somewhat similar to the GuarantCo product, by the guarantees group of the World Bank, DFI funding, including IFC and many, many others, and then MIGA covered the equity of EDF and STOA. Next. Another project in Senegal. This is the largest wind project in West Africa. MIGA covered, it's about 160 megawatt project, sponsored by Lekela Power, which is a joint venture between Actis and Mainstream. MIGA covered the equity, and you had OPIC and EKF on the debt. This closed last year. Next. And here's just an example of the credit enhancement where MIGA provided a guarantee for a loan from Deutsche Bank in Mizuho, about a 700 million euro loan, so quite substantial for 15 years to Eskom. This one was guaranteed by the Republic of South Africa. We do not necessarily require a guarantee, but it depends on the creditworthiness of the borrower. And I think I will stop there, Tony, and we can open it up for questions.
Okay, that's fine. So that's okay. If I just stop sharing there and then go back to the presentation, and then we can take the questions once. Yep. Okay. Okay, thank you very much for that, Hoda. And I'm just going to start very quickly before I can take questions from people. That's coming back very briefly. I'm going to be biased a little bit, right? So, because you know that I'm from Cameroon, so you mentioned Nachtigal, so which is a project many are proud of. So, you mentioned about covering some local risk, local currency risk there, and I was slightly surprised because I thought the CFA franc, because it's pegged to the euro, will not be an issue. So. Well, can you go a bit more specifically as to
sure.
what you're referring to there?
Just to clarify, Tony, and we can tap into Jules' knowledge, his expertise as well. In most projects, you have EPC contracts and you have a lot of dollar expenses, but there also are some local currency expenses that are required for O&M, for local. Some local equipment, etc. So in this case, and what I found, and again, I have to defer to Jules, who's the local currency guy, right? What we found is that the tenor that local banks can provide tends to be quite short. I mean, 5-7 years max. So using in that particular project, again, MIGA did not cover, to be clear, MIGA did not cover the local currency tranche. It was covered by the PRG. And GuarantCo has a similar instrument that can provide a guarantee to local banks for their local currency repayment, which often can lead to an extension in tenors. And I think Jules mentioned the refinancing option. That's one way in which it can be supported, or it can be within the existing tenors just to increase their overall ability and appetite and ability to provide longer tenor projects. But I think so Nachtigal was an example where you had a USD tranche, you had a foreign currency tranche, and you had a local currency tranche that was supported by the World Bank. But maybe I should also, this is a good segue to open it up to Jules to see if he has any comments on either on this project or on the particular elements of local currency that I mentioned.
Yeah, and before Jules jumps in, so I'm just going to add a new question that I have from somebody when you were presenting, Jules, which was, so how good is the sovereign guarantee? Because we tend to to listen to many developers that will be asking for sovereign guarantee, but I believe it's only as good as the government balance sheet, correct? So just want to add that to you.
Okay, before I jump into that question, I just want to add some comment on what Hoda just said on the local currency. Yeah, GuarantCo, what we provide is a local currency guarantee. When I say local currency guarantee, if we were part of the MIGA project in Cameroon and the local banks needed local currency cover, GuarantCo could be the product that they can take, because when we provide the guarantee, if there's any event of default and the bank needs to repay, we'll pay them in local currency. We will not pay them in hard currency. As our main role, as I've said, is to make sure that we can crowd in local currency as much as possible and take out any local currency, any currency burden from the local banks. I'm not saying that our product is meant to cover the currency exchange risk. By providing a local currency guarantee and being able to pay in local currency if there's any issue, if there's any event of default, we are kind of reducing the currency exchange risk on the commercial loan, right? So yeah, this is something that we GuarantCo can do, and then we are currently doing in other projects in other countries. Coming now to your question as concerning the sovereign guarantee, I think, Tony, it's a bit difficult to answer this question, because everything depends on how we perceive the risk of that country, and there's a lot of analysis to do to make sure that we're happy with the government guarantee, the sovereign guarantee that we are receiving, because there's a lot of parameters to put behind to make sure that we are happy with the sovereign guarantee. And I think it might not be the same view for the commercial bank, because their risk, they cannot perceive any risk on the government instrument, because they are located there. That's their risk that they are taking. So they are all happy to take the government risk. But as far as international investors are concerned, they might have to look at some of the ratings agency report to see how strong the country is, if it's something that they can take, and they will take their decision from there. So to answer straight on your question, it depends on the ratings, it depends on the country policy, regulatory environment, good governance, and all sort of elements which can come to provide comfort to the investor.
Okay, thanks for that. I also have another couple of questions just to make sure that I can pick up enough questions that I have received. So the first question is, which are actually, the two questions are linked. So what is the minimum size projects that both your organization will be interested in? That's number one. And the second question, which is sort of subsequent to that, is, do you only focus in government project, or could you be interested as well by private project, i.e. commercial and industrial?
I'm happy to answer those. We do not have a minimum or a maximum size, Tony. So we can consider projects of all size, and we recognize that a lot of these renewable projects tend to be quite small. So for example, the scaling solar project in Senegal that I presented, our guarantee ended up being something like $2 million each. I mean, it's quite small. So as long as it's highly, it fits our strategic targets and it's developmental, we can support it. Regarding the second question, yes, we can absolutely support offtakes to corporates, and in fact, very much looking more at the space. The only thing is that we cannot provide the breach of contract cover, which is the payment risk for that. So I mentioned before, that's the cover that's most in demand. When you have a private offtaker, because that's not considered a political risk, we can't provide that particular cover.
Okay, that's good. Jules, you want to come in, or if not, I have a question for you.
Exactly. As far as GuarantCo is concerned, our minimum size, as I've said during my presentation, is 5 million. 5 million meaning that you're in a project where the debt has a minimum of 10 million because we are providing 50%. The maximum we can provide per transaction is 50% guarantee for the debt, for the commercial debt. And the maximum is $50 million, which can help to raise $100 million commercial debt. As far as the tenor is concerned, our tenor policy said 15 years, but I have to say that we can have some exception. We did a transaction in Mali, and the transaction requires 16 years, and our credit committee were happy to do that.
Okay, good. Thank you very much, Jules. And I have a question for you, and after that, I'm with a question for Hoda. And the question was, GuarantCo is providing coverage for 15 years. We know the average length for project are 20 years, if not 20, 25 years. So the question was, what happened with the last 5 years? I found that quite interesting. And the second question, very quickly, so how long is your process? Because you showed us basically the pathway to get insurance from GuarantCo. So how long would that process take, roughly?
Yeah, question on the tenor. I think, as I've said, our tenor is 15 years as per the policy. But if there's any need to provide more than 15 years, we are happy to get the waiver from our donors to be able to do so. But we need to justify that the project is highly developmental, because the developmental part of the transaction is the main element that we're looking at when we want to be part of the transaction. We just want to make sure that every time when we provide a guarantee, that guarantee will help to raise the funding, mainly in local currency, and that project will help people alleviate poverty, increase poor people's revenues, and help the country to be developed. Those are the main point that we look at. As far as tenor is concerned, also, if the project, depending on the concession agreement signed, basically, if the concession has been signed for 20 years, it's going to be a bit difficult for us to provide a guarantee for 20 years, because we also need to have a tail on the concession, which will help you to kind of do some structuring if there's any issue at some point. So we will prefer to have that tail, and that tail will help us if at some point there's an event of default and then we need to restructure the project for another 5 years or for another 2 years, depending on the tail. That will help as well, right? It's a matter of how we structure the risk and how we perceive the risk. Yeah.
Okay,
so,
great. Yeah, sorry.
This question was on the timing. I have to say it's difficult to tell you exactly what's the exact timing to close a transaction, because all depend on the transaction. There are transactions where you start working on the 1st of January and then you close the transaction by the 30th of June. But I've been working on one transaction for the past 2 years. Not because GuarantCo is a problem, but because in the beginning, when we got into the transaction, we understood that we had a lot to do to make the transaction bankable. And we have been working with the sponsor and the banks to make sure that transaction is bankable. So our process provides a kind of short time period to get the approval. But before we get the approval, there are a few points that we need to make sure that we are comfortable with. And we also need to involve some advisors, external advisors such as legal, technical, insurance advisors, to help us to look at the risk and to provide their comments for us to know exactly what we need to do if there's any issue. And there's also, the timing can be longer because sometimes there's a lot of discussion, negotiation between GuarantCo, the lenders, and this project sponsor. Also, there's also a government element there, because there's a lot of bureaucracy in those governments. And sometimes by the time you think that you're going to close the transaction in 2 months, you just realize that by reading the legal report that the concession agreement, there's one issue in the concession agreement that prevents you from closing the transaction, and then you need to go back into a negotiation with the government and make sure that you sort that out before you get there.
Yeah.
And if the issue has to be approved by the parliament, you imagine that it's going to take a lot of time. So to answer that question straight is there's no typical timing to close the transaction.
Okay.
But GuarantCo on its side is always trying to make sure that it shortens the time. For example, most of the time when we're involved in transaction with local banks, we always have final approval before the local banks in terms of internal approval. Now, the remaining point are the negotiation with the government, with the sponsor, and also with the bank. And sometimes you see the bank coming with the approval like 6 months after GuarantCo has been approved.
I think, thanks for that, Jules. So I'm just going to try very hard to squeeze in 2 questions that are linked, and potentially a third that will be a little bit difficult. The question is, how often, and that's to you, Hoda, so if you can have a short answer for that, if you don't mind, because we only have 4 minutes left. So how often is the country risk reviewed and the pricing adjusts by GuarantCo MIGA? So that will be MIGA for you. And the second question is, government are expecting lower tariff. Is your pricing following? So if we can have a very squeezed answer, that would be much appreciated.
Okay, sure. Very quickly, our pricing is reviewed once a quarter, so every 3 months. However, that is pricing that is relevant only prior to issuance of a contract. Once we have issued a contract of guarantee, regardless of whether it's 10, 15, or 20 years, we cannot change the pricing regardless of changes in the country risk. And that's something very, very important that our colleagues in the private sector don't have. They typically have annual reviews of pricing. We are locked in for the life of the contract. And that's something that's quite valuable as the risk profile changes over time. For the second, sorry, what was the second question, Tony?
So the second question was government expecting lower tariff. Basically, are you following? Are you reducing your pricing with that?
Reducing our pricing.
Yeah.
Well, that's I guess I would answer by saying that specifically for renewable projects in sort of low income and fragile countries in Africa, we tend to give our very best pricing. And the concessional facility, the private sector window that I mentioned earlier, is meant for precisely these kinds of projects. So that when we can bring down our pricing, it then it eats in less into sponsors' IRRs and therefore results in an all-in lower tariff. Sometimes, right? It doesn't always work that way, but I wouldn't say that we reduce our pricing when the tariffs are lower, but we often see that governments are pushing to get lower tariffs just in order for those projects to proceed. And so that's been one of the things on our side that's been a major blockage to many of our projects in our pipeline proceeding, is that governments are sort of second guessing what they originally agreed in terms of tariffs in light of the new technology and lower pricing overall.
Okay, thanks for that. So unfortunately, we're running out of time. I think there was the last question looking at whether all renewable energy are covered. So I think I will respond to the person later on. I will get the answer from one of our speakers. So I think I just have time to say that it was a pleasure, obviously, for us to have you in this presentation today. So Hoda and Jules, so thank you very much for today's presentation. So the presentation will be available in a week's time, both the slides but also the recordings. And last but not the least, I'm just going to ask our people on the line very quickly to complete our survey that allowing us to make sure that we're addressing your concerns or what we can improve in what we're doing, and there will be much appreciated. I'm just going to give everybody let's say 15, 20 seconds to complete that. So I can see some people are coming in. That's excellent, superb, brilliant. and then another 10 seconds, and after that, we're gonna wrap up. Just for me to say, our next conversation will be in a month's time, and the topic will be announced very shortly. So, thank you again for joining. I'm just gonna stop the polling now. I think enough people have responded, and I'm just gonna say, thank you again. And you were talking to Renewables in Africa. The topic was strategy to adapt to mitigate the risk related to renewable energy projects. So we were talking to Hoda, Moustafa from MIGA, and also Jules Samain from GuarantCo, and I was attorney Tiyou. So you have on the slide there our contact if you want to get in touch. And don't forget our workshop. If you want to register, it will be a pleasure to have you. Last but not the least, thank you very much again for your support, and I wish you all a very nice end of your day. So thank you, and
thank you,
see you next time.
Tony. Thank you for inviting me.
Thank you.
Thanks, Tony.
Bye.